Chapter 7, International Management Approach. 7.1 Introduction to International Management. 7.2 Foundation of International Business. 7.3 International Business and Trade. Learning Objectives. Explain the concept of international management. Explain the key pillars of international business. Discuss the common international business approaches. 7.1 What is international management? International management is the management of business operations in an organization serving markets and operating in more than one country. It requires knowledge and skills beyond normal business expectations, such as familiarity with local market and competitive conditions, the legal and financial environment, the capability to do multi-currency transactions and managing across borders. 7.2 Foundation of International Business. 3 key pillars of international business. 1. International business actions, trading, investing, and globalizing. 2. International business actors, firms, governments and institutions. 3. International business systems, trade, currency, and finance. 7.3 International business approaches. There are many methods in international management that investors should follow as export/import approach, license approach, acquisition approach, joint venture approach, direct investment. Exportation approach. In international trade, an export refers to the selling of goods and services produced in the home country to other markets, other countries. Exporting is the most traditional and well-established form of operating in foreign markets. Exporting can be defined as the marketing of goods produced in one country into another. The seller of the goods and services is referred to as the exporter. Advantages of exportation. Manufacturing is home-based, thus, it is less risky than overseas-based, gives an opportunity to learn overseas markets before investing in bricks and mortar, reduces the potential risks of operating overseas. You could significantly expand your markets, leaving you less dependent on any single one. Greater production can lead to larger economies of scale and better margins. Your research and development budget could work harder as you can change existing products to suit new market. Disadvantages of exportation. Unless you're careful, you can lose focus on your home markets and existing customers. Your administration costs may rise as you may have to deal with export regulations when trading outside the European Union. You will be managing more remote relationships, sometimes thousands of miles away. In overseas markets, you may lose some of the control that you are used to at home. You will need to think of your new market differently to the home market. They will be different customers with their own reasons for buying your products. Importing approach. If you are buying goods from another country, bring and sell them in your region, then this course of action is considered as the import. In such a situation, you are going to be a buyer in the first place. Advantages of importing. Better profit, good quality, cut down manufacturing cost, operation cost, wages. Raw materials costing, intermediate goods costing, deal with emergency, a good and strategic decision. Disadvantages of importing. Currency risk. Currency rate starts declining in the international market, and other currencies start holding a dominating position. Domestic resources get a bad hit. Some companies are importing competitions or substitutes for domestic products. Due to all these things, locally made products of your country's market may get a bad hit. License approach. Licensing is a business agreement that involves the shared use of a trademark, technology, or other intellectual property asset. The agreement that creates a license relationship is a license agreement, and the parties to a license agreement are the licensor and licensee. Acquisition approach. Strategic acquisition, also called an acquisition strategy, is a method that one company uses to gain or purchase another, hoping the consolidation of both companies can prove to be more profitable than one by itself. In business terms, strategic acquisition usually occurs because one company thinks it can benefit from synergies. Joint venture approach. A joint venture occurs when two or more businesses join together to pursue a common project. Toyota and Mazda. In 2015, Toyota and Mazda announced a joint venture to build a manufacturing plant in the United States. The plant, which opened in 2021, is jointly owned and operated by the two companies. Direct investment. Direct investment refers to an international investment in which an investor from one economy establishes a long-term involvement and a substantial amount of control over an enterprise from another economy. This type of investment is also known as foreign direct investment. Thank you.